Welcome to the deep dive. So you shared some really interesting stuff from the Collaborative for Frontier Finance convening, the one in Kenya, Lake Naivasha.
That's right. Yeah, it was their 2025 annual convening. A really productive couple of days.
Looks like it. So our mission here is to pull out the key insights, about small business finance in emerging markets, particularly Africa, based on those discussions.
Exactly. And it was a diverse crowd fund managers, institutional investors, DFIs, pension funds, people from 23 African countries plus MENA.
Covering a lot of ground, sector-wise too.
Yeah.
Agri, climate, fintech.
Everything, yeah. And the main theme, sort of the thread running through it all, was this: Africa-centric policies and practices increase efficiency, reduce risk, acknowledge context.
Okay. Africa-centric. Makes sense. So what were some of the big takeaways? Where's the thinking heading?
Well, one major thing was the evolution in business models. We're seeing a definite advance in what they call ESCP business models.
ESCP.
Yeah, essentially combining revenue-based financing, RBF, with technology.
Okay, RBF. That's where repayments track revenue, right? Not fixed debt.
Precisely. It's much more flexible than traditional debt or even equity sometimes. And pairing that with tech, well, it's seen as a way to unlock capital for African entrepreneurs who might lack, standard collateral.
Interesting. A more adaptable approach then. What about the big money? Pension funds, for instance, you mentioned they were there.
Definitely a hot topic. The potential to mobilize local pension fund capital is, well, it's huge. CFF's work with NSSF Uganda is a great proof point.
NSSF Uganda.
Yeah.
They're the biggest in East Africa, aren't they?
They are. And crucially, they're actually seeing positive returns from their SME investments. That sends a powerful message.
It really does. Builds confidence.
And looking ahead, there's the All-Africa Pension Summit in Kampala, November 2025. The theme is Power Africa's Future. CFF is quite involved in the lead-up. Could be significant.
Something to watch, for sure. Okay, another shift seemed to be happening with philanthropic foundations, their strategy.
Yes, exactly. You could feel a real move towards more intentionality. Foundations are increasingly focusing on the specific needs of growth firms and, importantly, local capital providers.
So supporting the local ecosystem more directly.
Right. Things like the Growth Firms Alliance, the Catalytic Capital Consortium.
Yeah.
They're examples of these collaborative efforts really taking shape.
Got it. Now, we always hear about the missing middle in finance. Did the definition of that change at all?
It did seem to be evolving, yeah. It's not just that classic, say, $200K to $1 million gap anymore.
Oh.
Fund managers are saying there's real demand, significant demand for much smaller tickets, sometimes even down to like $20,000 for short-term liquidity needs. Depends on the sector, the market, of course.
Wow, $20. That really changes the game for fund structuring and product design, doesn't it?
Absolutely. It forces a rethink,
Wow.
which leads us nicely into catalytic capital.
Right. The patient, risk-tolerant funding meant to draw in more investment. How's that playing out?
We saw some great examples of it in action. It's becoming more sophisticated. Take Nyla Ventures. They're explicitly bridging the gap to DFI funding by blending pools of capital.
Blending, like different types.
Yeah. Climate funds, local capital, venture building support, all packaged together. Then there's Small Foundations Facility, helping African fund managers with working capital while they fundraise. That's critical runway.
That is critical.
And you've got the MasterCard Africa Growth Fund, a fund-to-funds model with technical assistance built in. And FASA, financing for agri-SMEs in Africa, providing subordinated capital and TA specifically for the agricultural value chain.
Lots of tailored approaches.
Yeah.
And CFF itself launched something, LONCH plus capital.
Yes, LONCH plus capital. It's their flagship integrated platform. Think shared services, technical assistance, and that catalytic capital, all designed to accelerate these smaller, often local fund managers.
So an incubator or accelerator for funds, essentially.
Kind of, yeah, an acceleration platform. We also saw some really smart financial engineering, like the FX swap model piloted by Shona Capital and KSF Impact in Uganda.
FX swap, to deal with currency risk.
Exactly. Channeling USD investment for local currency lending while mitigating that foreign exchange risk. Very neat. And also the Zambia Small Business Growth Initiative, a fund of funds led by the Bank of Zambia using a structured risk-sharing approach.
It seems clear that it's not just about dropping cash, is it? The support alongside the funding.
Oh, absolutely critical. That was a huge emphasis.
Right.
Technical assistance, TA, is seen as vital for value creation in the portfolio companies.
Not just an add-on.
No, moving towards structured TA funds, even building value creation plans before investing. And importantly, making sure that TA supports the whole team, not just the founder.
Right, building the whole company's capacity.
Yeah.
So wrapping up, it sounds like the convening really painted a picture of a very dynamic space, evolving, getting more sophisticated.
That's the key takeaway, I'd say. More sophisticated funding models, definitely more diverse investor engagement, and increasingly innovative ways to manage the inherent risks. It feels like progress.
Okay, so here's something to chew on then. Given these trends, the tailored funding, the catalytic capital, the focus on TA, even the shifting definition of the missing middle, how might all this really reshape investment strategies? Could this be the key to unlocking more, genuinely inclusive economic growth in these frontier markets? Definitely worth looking more into some of those initiatives I mentioned. Thanks for this deep dive.